Welcome to the Deep Dive. We're diving into a pretty in-depth report today, all about a potential market correction in 2025. It's definitely something that we're hearing a lot about these days, and I know it's got a lot of people feeling maybe a little uneasy, so let's just jump right in.
Yeah, market corrections, they always sound kind of scary, but they're actually way more common than you'd think.
Okay, so maybe not as scary as like a full-blown crash, right?
Yeah.
What exactly are we talking about here when we say correction?
Yeah, so a correction, it's like a dip in the stock market, somewhere between 10 and 20%. Usually it's in a major stock index, something like the S&P 500. It can feel kind of sudden, but usually it's pretty short-lived.
Short-lived, I like that. But you said they happen pretty often. Like, how often are we talking here?
Well, think about this. Since 1981, we've actually seen a correction like clockwork, almost every 1.2 years on average. And get this, in 2022 alone, there were 4.
Whoa. 4 in 1 year. Okay, so maybe not as rare as I thought. But what does that mean for 2025? Are we overdue? Or is it just impossible to tell?
We can't really predict the exact timing, but this report definitely points out some things that make a correction in 2025 more likely than just a random chance.
Okay, well, let's get into it then.
One of the biggest factors is what's going on in the economy in both the U.S. and in Canada.
Okay, so the economy, that's a big one. We keep hearing about potential recession, interest rates going up and up. It's kind of a lot to process. So break it down for me. What's the real story here? What's going to impact my investments?
The report's kind of pointing to this picture of modest economic growth, but there are a few things out there that are making folks nervous. Let's start with the U.S. economy. We're looking at growth forecasts somewhere around 2%.
Okay, 2%. So not huge growth, but not negative either.
Right. But it's not all rosy. There are a few things in the report that stand out.
Like what?
Well, Goldman Sachs.
Yeah, they're pretty well known.
Well, they're projecting something closer to 1.7% growth by Q4 2025.
Oh, wow. That's quite a bit lower than 2%.
Yeah. And there's especially concerned about tariffs, rising tariffs. They're saying those could really put a damper on things.
Yeah, tariffs, those are always lurking, aren't they? Always stirring up trouble. But what about inflation? I keep hearing it's cooling off. Is that the full story, or is there something more to it?
It is moderating, but it's still kind of like a wild card right now.
Okay, so like it's better, but it's not gone.
Right. Like in February, we saw headline inflation at 2.8%, and core inflation, that's the one without food and energy, that was at 3.1%. Projections for March are saying those will drop a bit, but it's still above what the Fed wants, what their target is.
Okay, so it's higher than they want it to be, and that probably makes things complicated for them, huh?
Yeah, it really complicates things. Like right now, they're holding steady on interest rates as of March 2025, but a lot of people think they might cut rates later this year. It's a lot of wait and see.
So nobody knows for sure.
Exactly. Nobody really knows when or by how much they might cut.
Yeah.
It's a lot of uncertainty, and that always makes people nervous, especially when it comes to their money.
For sure. Okay, so moderate growth, inflation that's kind of sticking around, and the Fed is, well, unpredictable. Anything else about the U.S. economy we should be keeping in mind?
Yeah, this slight uptick in unemployment.
Oh, so more people are out of work?
It's still, in that 4% range, but even a small jump can signal that things are slowing down, and that always makes investors a little jittery.
So not good news. Okay, so we've got this mix of moderate growth, stubborn inflation, and a Fed that no one can predict. Sounds a bit like, the perfect recipe for a correction, wouldn't you say?
It definitely makes you want to be cautious. And remember, we're talking about both the U.S. and Canadian markets, so let's look north of the border for a sec.
Yeah, because what happens up there definitely impacts us down here.
Oh, 100%. And it's interesting because they're also projecting, modest growth somewhere between 1.5 and 1.8%. But the big thing they're worried about is, you guessed it, those U.S. tariffs.
Yeah, those tariffs again. They always seem to come back to bite us, don't they?
Yeah, it's tough because, the U.S. and Canada, our economies are so closely tied.
Yeah, like a double-edged sword.
Exactly.
Yeah.
And to add to the uncertainty, Canada just saw this jump in inflation up to 2.6%, which is way higher than it's been. That puts a lot of pressure on the Bank of Canada to rethink what they're doing with interest rates.
This is really interesting because didn't they just cut rates?
Yep, you're right. They actually reduced their rate to 2.75% just in March, which is the opposite of what the Fed is doing.
Wow, so completely opposite approaches. Okay, well, at least Canada's unemployment rate has been pretty steady, right? That's got to be good news.
Yeah, it is a good sign. A stable job market is always good news. But it doesn't totally get rid of those worries about trade and rising inflation. Those are still the big question marks, the wild cards that could really shake things up on both sides of the border.
Okay, so we've talked about the economy. Now let's get into market valuations, PE ratios, that kind of stuff. I know it can get a little technical, but this report mentions some potentially high PE ratios. Can you break it down for me?
Of course, the PE ratio, or price to earnings ratio, is basically how much investors are willing to pay for every dollar that a company earns.
Okay, so like a higher PE ratio means a company is doing really well.
It can mean that, but it can also mean that a stock is maybe overpriced. A low PE ratio could be a sign that a stock is undervalued.
Okay, I think I'm getting it. So what are the ratios looking like right now?
So in the US, the S&P 500 is somewhere between 24 and 26. The NASDAQ is even higher, between 29 and 38. And the Dow Jones is around 23 to 25.
Okay, so those all seem a little high. What about Canada?
The TSX is a bit lower. The PE ratio there is between 15 and 22. But even that's on the expensive side when you compare it to its average over the past 3 years.
Okay, so both markets are looking a little pricey right now. But doesn't high PE ratio make sense if a company is expected to grow quickly?
Yeah, you're right. It's not always a bad sign, especially if a company is in a sector that's growing really fast. But what it tells us is that investors have high expectations for future growth. Those expectations are built into the price. So the question is, are those expectations realistic given everything else going on, the economy and all that?
That's a good question. Okay, so with these kind of high PE ratios, are investors feeling optimistic or are they starting to get a little spooked?
Well, that's where things get really interesting. The report's pointing to a pretty big shift in how investors are feeling, and it's not exactly positive. Welcome back to the deep dive. Before the break, we were talking about how investors are feeling, and it sounds like things are getting a little, shaky.
Yeah, a little shaky. So what is the report saying about investor sentiment?
Well, it looks like folks are starting to get a little nervous, especially in the U.S.
Okay, what makes you say that?
A couple of things, like the Bank of America, they do this global fund manager survey, and it's showing that sentiment has really taken a nosedive. And get this, they're seeing a record rotation out of U.S. equities.
Oh, wow, a record rotation out. That's not a good sign. What's driving that?
I mean, it's a lot of the stuff we've already talked about. The economy's kind of iffy, inflation is hanging around, and, those high PE ratios we were just talking about. We're also seeing that consumer confidence is way down, and individual investors aren't feeling too bullish either. It's kind of across the board.
Yeah, so it's not just the big institutions. Main Street's feeling it too. What about up in Canada? Are investors up there feeling the same way?
Yeah, there's definitely a lot of anxiety in Canada too, especially when it comes to those trade tensions with the U.S. Consumer confidence is down. People are worried about jobs and what's going to happen with the economy. It's like those tariffs are casting a pretty big shadow,
Yeah, no kidding. Okay, so we've got these potentially overvalued markets and investors who are, well, basically freaking out a little bit. Not exactly a smooth ride. But what could actually trigger a correction in 2025? Like, what are the warning signs?
That's the big question, and this report does a good job of laying out some potential triggers. First up, we've got to watch those trade and tariff policies.
Oh, those tariffs again.
Yep, they're creating so much uncertainty, and they could really throw a wrench in the economy, both here and in Canada.
It's kind of like a game of Jenga, isn't it? Like one wrong move and the whole thing could just collapse.
Exactly. And the other thing that's a real nail biter is that whole inflation interest rate dance that the Fed is trying to do. If inflation doesn't come down, it really ties the Fed's hands when it comes to cutting rates.
Right, because if they cut rates too quickly and then inflation goes back up, that's not good either.
Right, exactly. And if you look back historically, sometimes when the Fed starts cutting rates, it can actually be a sign that a correction is coming.
Really? So cutting rates could make things worse.
Well, it just adds to the uncertainty. And then there's geopolitics.
Don't even get me started.
I know, right? Like the whole U.S.-China thing, the war in Ukraine, the Middle East, it's just a lot of instability out there, and that always rattles the markets.
Yeah, it's like a domino effect, isn't it? One thing happens over there, and then it ripples out everywhere. Okay, so trade wars, inflation, crazy geopolitics. Anything else we should be watching out for?
Well, the report also talks about how, sometimes economic news can just come out of nowhere and really shake things up.
Like what kind of news?
Like if GDP growth is weaker than expected, if inflation suddenly spikes up, or, if the jobs numbers are disappointing, stuff like that can really spook investors, especially if it goes against what everyone thought was going to happen.
It's like getting a bad grade on a test you thought you aced.
Exactly. Speaking of bad grades, the report mentioned this forecast from the Atlanta Fed. It's called GDP Now. And right now, it's saying that the U.S. economy is actually going to shrink in the first quarter of 2025.
Oh, so they're predicting negative growth.
Yeah, and if that actually happens, it could really trigger a sell-off.
So we've got a whole lot of stuff that could potentially spook the markets. But what are the experts saying about all this? Are they, battening down the hatches, or are they still feeling pretty good?
I'd say the general feeling is definitely cautious. A lot of experts are expressing some real concern.
Okay, give me the dirt. Who's saying what?
Goldman Sachs, remember we were talking about them?
Yeah, those guys.
Well, they're saying there's like a 30% chance of a major downturn, and they've lowered their year-end target for the S&P 500.
30%? That's a pretty big chance. Anyone else saying something similar?
Yeah, JP Morgan Chase. They've actually upped their forecast for a recession to 40%, but they're still holding on to their S&P 500 target of 6,500 for now.
Okay, so mixed signals. What about Morgan Stanley? What are they thinking?
They're basically saying don't expect huge gains in 2025. They're saying valuations are full, which I guess means they think maybe the market has already gone up as much as it's going to.
So maybe not a crash, but definitely a slower growth.
Yeah, something like that. Vanguard's a little more optimistic. They're still saying the U.S. economy will keep growing, but they're not ignoring the risks, all that stuff with trade and all the other question marks out there.
So a little bit of a different opinion there.
Yeah.
What about the big names? Like, what's Warren Buffett doing?
Well, this is really interesting. Berkshire Hathaway, that's Buffett's company, they were actually a net seller of stocks last year in 2024.
Oh, wow, really? That's a pretty big deal coming from him.
Yeah, it definitely makes you wonder. And it's not just him. Ray Dalio, the guy from Bridgewater, he's worried about a potential debt crisis, and he thinks a lot of the big stocks are way overvalued.
Wow. Okay. So some pretty big names are expressing some serious doubts. This is making me want to check my portfolio.
It's a good time to check in with yourself and your investments for sure.
Yeah. Okay. So we've got all this going on, the economy, investors getting nervous, big names getting cautious. But what does it all mean for different parts of the market, like different sectors? Are some more at risk than others if a correction happens?
100%. Some sectors are definitely more vulnerable than others. And knowing which ones are most likely to take a hit and which ones might actually do okay can help you make smarter decisions with your money.
Okay, so which sectors are you keeping an eye on? Which ones are you worried about?
Well, one sector that's been on fire lately is technology, and especially AI, artificial intelligence.
Yeah, AI, everyone's talking about AI these days, but why is that sector considered vulnerable? I mean, it's the future, right?
I mean, yes, it's super hot right now, but that's part of the problem.
Yes.
AI companies have seen this huge surge in their valuations, so the expectations are super high. And if they don't meet those expectations, even by a little bit, investors could get spooked and start selling,
So it's a classic case of what goes up must come down.
Exactly. A lot of people are worried that it's a bubble, and bubbles, well, they have a way of bursting.
Right. Okay, so AI, what else?
Another sector that's really sensitive to what's going on in the economy is consumer discretionary.
Yeah.
That's all the stuff that people want but don't necessarily need, like fancy clothes, vacations, new cars, that kind of stuff.
Okay, yeah. So like the nice to haves, not the must haves.
Right, exactly. So if the economy slows down or people start feeling less confident about their jobs, they're going to cut back on that stuff first.
And that would hurt those companies.
Yeah, it would definitely hit their bottom line. And this is a sector that's already dealing with inflation and supply chain issues, so a correction could really make things tough for them.
Okay, so tech and consumer discretionary. Anything else?
Energy is another one that's always kind of unpredictable. Oil prices go up, they go down, you never know what's going to happen. And if there's any disruption to supply or demand, it can really shake things up.
So even if the rest of the ownership is doing okay, energy stocks could still go haywire.
Yep, pretty much. And if there's a broader market correction, energy stocks tend to get hit harder than other sectors. They're very sensitive to changes in the economy and investor sentiment.
Got it. Okay, so tech, consumer discretionary, energy. Any others?
The last one I'll mention is financial services. So banks, insurance companies, those kinds of places, they're really tied to interest rates and how the overall economy is doing.
So if the Fed cuts rates or the economy really tanks, these companies are in trouble.
Yeah, they could definitely see their profits shrink and their stock prices go down. Plus, we've already seen some banks struggling with bad loans and things like that. A correction would just make it worse.
Okay, so those are the sectors that are most at risk. But I'm also wondering, is there anything that might actually benefit from a correction? Like, are there any safe havens, places where I might want to shift some of my investments?
That's a great question. And yeah, there are definitely sectors that tend to be more resilient during a downturn. They're called defensive sectors because they provide goods and services that people need no matter what.
So kind of like the essential businesses of the stock market.
Right, exactly. So these sectors don't tend to swing up and down as much as others. In fact, sometimes their stock prices even go up during a correction because investors are looking for safer places to put their money.
Okay, so what are some examples of these safe havens?
A classic example is healthcare. People always need healthcare, whether the economy is booming or busting. Doesn't matter if the market's down, people still need to see their doctor, fill their prescriptions, get those medical procedures.
True. Can't exactly put off going to the doctor just because the market's down. What else?
Consumer staples. That's all the everyday essentials like food, drinks, household products, personal care items. No matter what's happening in the market, people still got to eat, drink, keep their houses clean.
Right, you can't really cut back on that stuff too much.
Exactly. So the consumer staples companies tend to do pretty well, even when the economy is uncertain.
Okay, so what's the last one?
Utilities. So electricity, gas, water, all the stuff you need to keep the lights on and the water running.
Oh, right, those bills never go away.
Nope. No matter what's happening in the market, you got to pay those utility bills. So those companies tend to be pretty stable.
Okay, this is super helpful. I feel like I'm getting a much better understanding of how all this works. So just to recap, the vulnerable sectors are tech, especially AI, consumer discretionary, energy, and financial services. And then the safer bets are healthcare, consumer staples, and utilities.
You got it. And remember, this is just a general overview, Always a good idea to do your own research and maybe talk to a financial advisor to make sure you're making the right choices for your own situation and goals.
Yeah, that's good advice. So now that we know which sectors to watch, what can we actually do to prepare for a potential correction?
Great question. Let's move from, just observing to taking action. There are some really practical things you can do to not only survive a downturn, but maybe even come out ahead.
Okay, I'm all ears. What's the first step?
Diversification. We touched on this a little earlier, but it's so important. I think it's worth repeating.
You know what they say, repetition is the mother of learning.
Exactly. Diversification is like the golden rule of investing. It's all about spreading your investments across different asset classes, different sectors, different parts of the world even.
So don't put all your eggs in one basket.
Exactly. Diversification basically helps reduce the overall risk in your portfolio and makes it more resilient to those market swings.
Okay, got it. Diversification is key. What else?
The next thing is take a good look at your asset allocation. That's the mix of stocks, bonds, real estate, cash, all that stuff.
Oh, right. So like how much of my money is in each bucket?
Exactly. And that mix, that's going to depend on your situation, your goals, how much risk you're comfortable with.
Yeah, like if I'm younger, I might be more comfortable with more risk.
Exactly. If you're younger, you've got more time to ride out those ups and downs, so you might have a bigger chunk of your money in stocks. But as you get closer to retirement, you might want to shift more into bonds, which are generally considered safer.
Makes sense. And if I'm really worried about a correction, should I, maybe sell some of my stocks and buy more bonds?
Well, that's definitely something to think about, but you should really talk to a financial advisor before you make any big changes. They can help you figure out what's right for you, your risk tolerance, your goals, all that stuff.
Good point. Okay, so diversification, asset allocation. What else?
Build a cash reserve.
Good old cash. But isn't it better to have all my money invested so it can grow?
It's true that you want your money to work for you, but having some cash on the sidelines can really give you some peace of mind and some flexibility, especially if the market takes a dive. It's like a buffer. It can help you avoid making emotional decisions,
Yeah, so if the market crashes, I can just, buy the dip.
Exactly. Having cash gives you the opportunity to buy those stocks at a discount when everyone else is selling. And it also helps you avoid having to sell your own investments at a loss if you need money for something else, like an emergency or something.
No, that's smart. So it's like an emergency fund for my portfolio.
Exactly. It's there to protect you, to help you stay calm and make smart decisions.
Cash reserve. Got it. Okay, what else can I do? This might sound kind of naive, but is there any way to, predict when a correction is going to happen so I can get out before it hits?
I wish. Everyone wants to be able to time the market perfectly, but it's so hard. Even the pros get it wrong all the time. You can be aware of the risks and the signs, but trying to predict exactly when things are going to happen, that's almost impossible.
So even with all this information we've been talking about, we still can't really know when a correction will happen.
Nope, it's kind of unpredictable. And trying to time the market can really backfire. If you sell everything thinking a correction is coming and then the market keeps going up, well, you've just missed out on those gains. And if you wait too long to get back in, you might end up buying at a higher price.
Oh, yeah. That would be frustrating. So what should I do instead?
Focus on time in the market, not timing the market.
So just stay invested and ride out the ups and downs.
Exactly. The market goes up, it goes down, but over the long term, it generally goes up. So by staying invested, you're more likely to benefit from that.
That makes sense. Okay, what if I'm just, really risk averse? Like I don't like seeing my portfolio go down at all. Are there any strategies for someone like me?
Yeah, if you're really concerned about losses, you might want to look into hedging strategies.
We talked about hedging earlier. Can you remind me how that works?
Basically, hedging is like buying insurance for your investments.
Yeah.
You use these financial tools like options or futures contracts to try and protect yourself from losses.
Okay, so it's like I'm paying for some peace of mind.
Exactly. But just like insurance, it comes at a cost.
So I'm paying for it even if I don't end up needing it.
Right. And if the market moves in a way that you didn't expect, you could actually lose money.
So hedging is not a sure thing.
Nope, it's not. It can be a useful tool, but it's also pretty complicated, and it comes with its own set of risks.
Okay, so diversification, asset allocation, cash reserves, time in the market, hedging. What else? Is there anything else I should be doing to prepare?
One last thing. Stay informed.
Stay informed. Okay, like keep up with the news.
Yeah, keep an eye on what's happening in the market, the economy, what the experts are saying. Read articles, listen to podcasts, stay in the loop. And be prepared to, adjust your plan if you need to.
So don't just set it and forget it.
Exactly. Things change. You got to be ready to adapt.
Wow, this has been so helpful. I feel like I've learned so much about, corrections and what to do about them.
I'm glad to hear that. The more you know, the better prepared you'll be, and the better decisions you'll make.
Okay, so just to summarize what we've talked about, diversify, review your asset allocation, build up that cash reserve, focus on time in the market, not timing the market, consider hedging if that's right for you, and stay informed.
Got it. You got it.
This has been awesome. I'm feeling a lot more prepared than I did when we started this conversation. Now, before we move on to the last part of this deep dive, is there anything else I should be thinking about?
Well, we've talked about all the practical stuff, but there's one more piece of the puzzle, and that's your mindset.
Oh, right. Emotions.
Exactly. Join us for part 3, where we'll talk about how to stay calm and focused when the market gets crazy.
Welcome back to the deep dive. We've talked about all the economic stuff, potential warning signs, and we've even built ourselves a little financial life raft, but now we need to talk about the person steering that raft, you.
You can have the sturdiest boat, the best maps, all the right equipment, but if the captain freaks out when the seas get rough, well, it's going to be a bumpy ride.
That's a great analogy. And yeah, I'll admit when I hear about a potential market correction, staying calm is not exactly my first reaction. So emotions, why are they so important when we're talking about investing, especially when things are uncertain?
Well, fear and greed, those are powerful emotions. Yeah. And they can really mess with our decision making. Like when the market's going up, it's easy to get carried away, take on more risk than we normally would. But then when the market drops, fear takes over and we end up selling everything, maybe at a loss. Decisions we regret later.
Yeah, it's like that fight or flight response kicking in, but instead of running from a bear, it's a bear market.
Right. And those knee-jerk reactions can really hurt us in the long run. When it comes to reaching our financial goals, that's why learning to manage those emotions, to be disciplined, is so important, especially when the market's going up and down.
Okay, emotional discipline. I like the sound of that. But how do I actually do that? Like, what are some practical tips for someone who, maybe gets a little emotional about their money?
First thing to remember is that market corrections, they're normal. They happen, and the market always recovers. It's kind of like the seasons, Winter comes, we prepare for it, but we know that spring's coming eventually.
That's a good way to think about it. It's easy to get caught up in the moment and forget that the market has always bounced back in the past. What else can help me stay calm when things get rocky?
Focus on the stuff you can control. You can't control the market, but you can control your reactions, how you respond, stick to your plan, even when it feels like you should do something drastic. Don't let fear or greed make those decisions for you.
Trust the plan. Okay, I like that. But what about all the noise Like all the different opinions and all the news? It's easy to get overwhelmed and start second-guessing myself. How do you deal with that?
Yeah, that's a big one. The news loves to make things sound dramatic, especially when the market's volatile. I would say, limit how much news you're consuming, financial news especially. Focus on your goals, the long term.
So, like, turn off those stock alerts.
Yep, exactly. This is a marathon, not a sprint. You don't need to be checking the market every 5 minutes.
Okay, tune out the noise. Check. What else can I do to stay calm when the market's doing its thing?
Remember why you're investing. Think about your goals. Are you saving for retirement? A house? Your kids' college?
Ah, the big picture. Yeah, it's easy to forget about that when you're staring at your portfolio and it's all red.
It happens. But connecting back to your why, that can keep you focused, It reminds you that those ups and downs, they're temporary. The long game, that's what matters.
That's a good point. Okay, any other tips for staying sane when the market's going crazy? Sometimes it helps just to talk to someone.
That's a really good point. Talk to someone you trust, a financial advisor, a therapist, a friend, someone who can help you process what you're feeling and make sure you're making rational decisions.
Yeah, like a sounding board.
Exactly. Yeah. Sometimes just talking things out can help you calm down and see things more clearly. Avoid making any rash decisions you might regret later.
Okay, so those are some great strategies for, keeping our cool. But what about specific things we can do with our portfolios during a correction? Like, what should I actually be doing with my investments if the market tanks?
Well, the number one thing, and this is so important, don't panic sell. I know, it's tempting. You see your portfolio dropping and you just want to get out before it gets any worse. But selling when the market's down, that just locks in those losses. You're better off riding it out and waiting for things to recover.
So just take a deep breath and remember that historically, the market always comes back.
Exactly. And this is where that cash reserve comes in. Remember we talked about that? Well, if you've got some cash on hand, a correction can actually be a really good time to buy stocks at a discount.
Oh, yeah, buy low.
Exactly. Like a sale at your favorite store.
Yeah.
You get to buy the things you want at a lower price. Just make sure you're buying companies that you actually believe in, not just because their price is down.
So do your research. Make sure they're good companies.
Yep, exactly. Don't just buy something because it's cheap. Look for companies that have a good track record, solid fundamentals. Think of it as investing in good businesses, not just pieces of paper.
Okay, buy on the dip. Got it. What else? Is this a good time to make changes to my portfolio?
Yeah, a correction can be a good time to step back and look at your portfolio, make sure it still aligns with your goals and your risk tolerance. Maybe you need to rebalance things or shift some of your assets around. And this is definitely a good time to talk to a financial advisor. They can help you make sure you're on the right track.
Yeah, another good point for the financial advisor. This whole conversation has been so insightful. I feel much more prepared to handle whatever the market throws at me. But before we wrap things up, is there like a key takeaway message, something I can remember when those market jitters start creeping in?
Absolutely. While a correction in 2025 is a real possibility, it's not something to be afraid of. If you're prepared, if you stay disciplined and focus on the long term, you can handle anything. Remember, you're in control. You've got this.
Love that. I am in control. It's a great reminder that I can handle this. Thanks for joining us on this deep dive into market corrections. We hope you found this helpful. We'll see you next time.